welcome to One-to-One Mining Investment London Spring Edition. Welcome everyone, ladies and gentlemen, distinguished guests. It's great to have you all here. We've got our investment leaders panel, and I've got my panelists up on stage. Cailey from Blackrock, Coille and Alphen from Equinox Partners, James Hayter at Electrum Fund for Baker Steel Capital Managers, Philip Clegg at Orion Resource Partners, and Henry Steele at OD Natural Resources Fund. So thank you very much for joining me, everyone. Why don't we start off? Look, there's been some significant market dips over the recent weeks, sell-offs in tech stocks dragging into other sectors, S&P's down. One of the headlines I'd read this morning is nowhere to hide. That was something that was coming out of Davos, another event going on around the world today at the moment. Is it all real doom and gloom? And how does this put the mining sector at the moment? Henry, do you want to start us off with your sort of headline view of where we're at?
Yeah, absolutely. So I think there's quite a lot of differentiation within the market at the moment, from different commodities perspective. Obviously, on the demand side, the supply side is holding up very well for everyone. The demand side is where the risk is, and in China, what one's seeing obviously is rotation from spending on property. All the classic metrics are looking more worrying, or have been looking more worrying for the last few months, and therefore, kind of the hit on iron ore has obviously been clear. It's held up very strongly in copper, and really, I suppose, look, these are, from our perspective at least, kind of short-term issues. It shouldn't really kind of be impacting the question around energy transition, all the things we know about. So looking at kind of the spot volatility from events that are going on is probably not the most important thing to be doing at the moment. So from a capital raising point of view, and from a long duration assets like in the mining industry, it shouldn't be of too much consequence. The big one obviously has been thermal coal, met coal, that everyone's been very excited about. And I think what we saw 2 years ago was people drawing very large conclusions from oil and from copper. Spot prices rallying, and people taking these, saying, look, the energy transition is causing spot prices to rally. It wasn't quite true. In the same way that the things that are going on in Russia today aren't necessarily kind of the most important thing with thermal coal prices outside Europe in particular. So one has to remember the leverage that exists in the seaborne thermal coal market from China. So China's ability to kind of swing the seaborne coal market just by putting a few tens of millions of tons onto the market massively changes pricing. So there's huge leverage in that, and with China having taken some of those tons off the market, there's less pressure on the supply side, effectively in the seaborne supply side. So that's been driving a lot of the strength in seaborne thermal coal pricing, and that kind of feeds through to a lot of other commodities. For example, aluminium. We'll probably talk about this in a bit, so I'll hand it on. But that's kind of a very interesting area, in particular for us.
So you're not seeing this energy transition sort of stalled or inhibited by what we're seeing with this binge on hydrocarbons, the oil price and the coal, as you've described?
Yeah, well, I think high prices reinforces the energy transition. High prices of fossil fuels reinforces the energy transition. It allows, in some areas, the returns to look a lot more exciting on solar and wind. The issue then becomes on cost inflation on solar and wind. So, when one has fixed price PPA, kind of the offtake being a fixed price, and then your assumptions being on your capex, particularly if your capex is blowing through, suddenly your margin is squeezed massively. So the critical piece is actually in the offtake pricing. There's 10 years or even 12, 15-year PPAs that you get from solar and winds to ensure that they have that inflation adjuster of some sort, because otherwise your margin's going to blow through and your project's gone. So again, I think there's much more focus on inflation, on kind of risk identification, risk allocation, and risk pricing. And it's quite clear at the moment, it's kind of inflation is the big risk at the moment. So we don't see kind of the energy transition stalling. And in fact, it should naturally be that the high prices from fossil fuels should cause more of a progression towards the energy transition.
Okay, excellent. Cool. Let's introduce Equinox Partners, and what's your take on these macro themes around, inflation, stocks sell off. Is this an opportune time for metals and mining?
Sure. Equinox Partners is a Connecticut-based hedge fund. I run the precious metals fund. We invest in precious metals and copper. In terms of volatility, I think obviously we're all living it, but I think it's actually an interesting time because you're finally seeing sector rotation and people are having to reevaluate their investment theses. And to me, that's constructive for precious metals because people are talking about inflation and the VIX is at 30. That doesn't seem quite accurate, representative of the risk that's in the market right now. And so when I look at ways to diversify a portfolio, precious metals seems like a good place to be.
So with the inflationary pressures, you're going to see a lot more activity or interest in sort of gold juniors, gold miners, that kind of thing?
I mean, I think it depends on sort of your duration and your time investment horizon. But in terms of, if you look historically at how gold has performed in inflationary or high risk environments, it's done quite well. So depending how you're thinking about managing your portfolio for inflation, I think it certainly has its attributes of being positive. And I think in terms of the equities, they're not expensive. They're all trading at sort of double-digit free cash flow yields in terms on the senior side. So you can sit there and say, okay, well, I'm getting diversification and I'm getting a good yield. So to me, it seems like a place to, I don't want to say hide out, but it certainly has its benefits.
Yeah, the rotation into sort of more value stocks rather than these growth stocks that we've seen. Yeah, okay. Cailey, what's your take on this global scenario that we find ourselves in, and how positive is it for metals and mining at the moment?
Yeah, thanks, Adam. Look, it's a crazy environment at the moment. We've gone from COVID to a global, what's been turned into a sort of global conflict, and now into a massively inflationary environment, which for some bizarre reason has seemed to have caught everybody out. Well, what do you expect when commodity prices, particularly oil, are at an all-time high, and you're struggling to get ships to go down into ports? So, it's an incredibly tough environment to pick through. The US is faring far better, and of course that strong US dollar is one of the big reasons why commodity prices have been weak. And then, of course, what's going on in real rates? Well, no surprise, as central banks try to fight all these inflationary pressures, no surprise the central interest rates get raised, and that puts pressure on equity markets. So there's lots of things going on. The underlying theme, I think, doesn't change to previous points, that part of this energy transition and part of this net zero climate move, commodities needs to be a big part of that. And I think oil and gas companies in particular have been very eloquent in voicing that they need to be part of that. I think we probably need to, on the mining side, need to pick up our game a little bit as well, because we're integral to if we want the world to be like we hope it to be, then we need to be a part of it, and we need to showcase that we are part of it. So, in the short term, as Henry said, I'm pretty worried about the markets. I think for the next few months, I think they're going to be pretty soft, commodities in particular. But beyond that, I think this all this pressure is doing is rising. It's like a rising cost floor, if you like. And that's going to give a base level to a lot of these commodity prices. Let's take copper, for example. Whatever it is today, $420 a pound. Do I think it's going to go back down to $2? No. But do I think it's going to go to $5? Probably not. Somewhere around here is probably a reasonable price for it, for example. So that's a good example, I think, of this kind of environment we're in, which is, it's good. It's a good environment for us.
Just on your point around the mining sector might need to be doing more around decarbonisation, Is it that it's not doing it, or is it that it's not telling the right story, the right narrative? Are some companies doing it? Just elaborate on that a little bit.
Probably all of that, I would say. Yes, I mean, they're making efforts to do it. They can't get around the fact that we are an energy-intensive business. So, who's going to change the energy consumption of this planet? Is it going to be, pick your company, is it going to be Facebook, or is it going to be the mining industry? It's going to be the mining industry. So we've got to be custodians of that. And I think we need to do better in marketing it and saying that how we're going to change. And I think we need to be better about how quickly we can do it. But that's also the challenge. It's a very big, slow, Titanic-sized ship to turn around and retrofit your mine to be instantly green. So it's going to take time, but we all just need to sort of step on the gas as quickly as we can, show that we're doing it, and in time, I think we'll get there.
Yeah, no metaverse without mining, I suppose. But is the capital there? Is it coming in the droves that we need to kind of make these changes and these adjustments? One of the things was touched on at Cape Town a few weeks ago was sort of like OEMs looking a bit more upstream, but they're still not becoming equity partners in mining companies. Do we need to see more of this generalists coming through? I mean, every year we do this. We do generally say that, but are you seeing a difference there, a change there? Are more people calling your phones? Anyone would like to comment? Philip?
Yeah, sure. Just as it pertains to the energy transition and decarbonisation, absolutely. There's some recent statistics that came out with, I think it was Benchmark mentioned that by 2030 to meet lithium demand, the sector needs $42 billion of investment. Okay, that's like 7.5 years away. That's a huge amount of investment. And another analyst said that in rare earths, for us to meet the demand today, which is only increasing for wind turbines, so these are rare earth magnets, we need 5 times the supply. So these are huge numbers and massive step changes in the industry. And so we definitely need more capital in the space. And to do that, we need different forms of capital. So Orion has always been there, long-term capital, long-term patient capital, and a provider of capital to the mining sector, both in golds and in energy transition commodities. But it's going to require much more than that. And I think at some stage, yes, the generalists will need to come back in. It hasn't really happened so far, but I think there does need to be a new form of capital that comes in, and that's most likely from the OEMs. And they have started to flirt a little bit with the upstream, but I think that it'll be this year and next year when it starts to actually happen.
Yep, excellent. James, what's your view? You have the various funds that you manage across the commodities. Are you seeing more interest from a broader range of LP?
I run the Electrum fund, so we have a focus on future-facing commodities, and in terms of that big thematic, the push towards net zero in 2040, 2050, yes, that's absolutely intact. We're not going back to build huge new coal mines on a global scale. So yes, we're moving towards that net zero target, but it's going to be incredibly volatile, and we've really got the first taste of that this year. And if you do this without a plan, you're going to increase that volatility, and you can draw pretty much a straight line from China's decarbonisation to higher power prices within China, higher aluminium prices, demand for copper as a substitute, then higher LNG prices. In Europe, even before the Russian invasion of Ukraine, because of imports into China, that obviously then put pressure on fertilizer prices. We're now seeing that in food prices, and it's, in my view, fairly likely that we're going to see greater political instability and higher gold prices as a result of those higher food prices. So other factors flowing into that, but just as an example, if there isn't a plan, you are going to get some volatile price moves, and it's not the most efficient way for us to run this industry. If we could all come together and find a better way, we should do. I think I probably agree with Phil. We're a little bit too late in a lot of these areas. We're not going to invest $42 billion in the lithium industry in the next 7 years. we are going to run into shortages, and we're going to have to find a way around that. So in the Pacific example of lithium, we're probably not going to be able to use lithium-ion batteries as grid storage batteries. We're going to have to look for alternatives to that because we just won't have the raw material supply. We've been through this before. Rare earths, I was there for the first big rare earth spike and then collapse, and we all said we're never going to do this again. We're going to diversify away from China. We're going to build downstream processing plants and upstream mines, and we're going to permit it. And we didn't do it, and now we're going to be in exactly the same problem we were 10 years ago. So yes, the end users are a big part of the picture. They do need to go upstream. I'm not sure they need to own mines directly. They probably need to start talking seriously about pricing offtake agreements and giving premiums for that. I note that Daimler announced at Christmas they are prepared to pay a 30% premium for rare earths that didn't touch the Chinese supply chain and guarantee volumes with those contracts. I think that's a model that we're going to have to use, particularly in these smaller markets where producers can't hedge their production out and consequently find financing more difficult. So yeah, I think that's where we are. In terms of generalists, no, we're not there yet. I wouldn't expect them to be there. The last super cycle, we probably had prices move 03, 04, and equity prices really didn't move till 2 or 3 years later. I see no reason that shouldn't change this time. Probably even worse because a lot of the guys lost money at the top of the last cycle. So I think we're a good few years away from that.
Right, certainly. And the ESG element, is that holding the generalists back at all as well?
It does. I think all of us up here, we all work hard at it. I think the industry overall works hard in terms of ESG. I agree with Cailey's point. It's not universal, and there are some pockets where they're not doing enough with ESG. But I think overall, as an industry, we don't do a good job of highlighting the work that we do. You can't build a just transition without mining. We also don't highlight the fact we're investing in people and places no other industry does, and we're giving opportunities to people and places that no other industry does, and we don't highlight that at all, and we need to do a better job of doing that, and that's everyone involved in the industry.
Yeah. Just coming back to your point around the supply shortages, focusing on the material supply shortages, are we going to see a default perhaps in a contract of a sort of a lithium supplier to an OEM, for instance? Are we at a risk of this as a disconnect at the moment?
Yeah, in my experience, actually, there's defaults all the time. One of the things that people don't quite appreciate about the lithium space, particularly as it pertains to hydroxide, is how really difficult it is to produce on-spec material. It doesn't last for long either, so you've got to deliver it on time too. And so in my personal experience, and we have 2 lithium investments, is that actually it takes time to qualify. And if you send like 1 ton of product that's not on spec, they just reject it and you don't get paid. It takes time to then rectify that situation. So there are defaults all the time. And it's something that actually, us as investors, and myself, I've made a mistake in this before, is not really understanding the working capital requirements of getting these assets online, but on spec.
Right. Yeah. The battery grade product at the end of the day is critical. Interesting. Okay. Anyone else got a comment on sort of supply shortages? Because, I'm sort of hearing that, higher prices and everything's going to drive the cycle forward, enhance the energy transition, as you mentioned, Henry, but the supply crunch and the sort of Russia's supply going offline just sort of suggests the opposite, and maybe in the short term, I suppose.
Yeah, I would just say, I think it's so difficult for generalists to go into the space that where is the capital coming from? It doesn't really need to be specialists or generalists from the West. I mean, the Stanmore example, buying BMC from BHP, is a classic example. That's Southeast Asian money. It's effectively family money. Coming in, they can buy kind of semi-met coal assets. They attract, the valuation, mega attractive. BHP needs to push the assets off. And that money there was a mixture as a listed company in Australia. Stanmore is not even covered by the sell side at all. But for us, that's a very, very exciting investment. Not covered by the sell side. The management have a big incentive for it not to be covered by the sell side. The long-term incentive plan isn't even in place yet. It's going to be based off the TSR, so they clearly have an incentive, at least, to sandbag the equity price for the moment. So, what we're seeing is the really attractive stuff on the listed side is very much the fresh capital is being provided by Middle Eastern or or Asian money, and often private/family in that kind of method. It's just very difficult for fresh capital in the very attractive valuation stuff to be coming from, generalists that are all under the scrutiny of all these different stakeholders. They have a much more of it. I want to make money in Asia, Middle East, and that's their primary objective. It's not about satisfying the different stakeholders. So I think kind of the fresh capital logically kind of makes sense in these more difficult commodities, let's say, that have more of a sensitivity to them. But there are the opportunities that it's not very well talked about for in the public markets.
Okay. Let's talk about the mining companies now and the top tier, the majors. Henry, you had some views when we spoke in preparation for this around what sort of the majors should be doing at the moment. And do you feel that the majors need to be investing more in the industry, upping their M&A, or putting more stakes into sort of the juniors, JVs, that kind of thing, to really help this material supply shortage challenge?
Yeah, look, I think with the M&A, I think it's for producing assets often has been very difficult to justify that, particularly a premium being paid. The very few cases where there has been value derived by the new management coming in. M&A, a large part of it is justified by balance sheets, which is, I think, the right type of M&A. Really is lending balance sheets. The big guys are there to, they make money by taking risk. Everyone's making money here by taking risk. So it goes back to the question of what is the reason of these big guys being there. If you kind of go back to the 60s, 70s, really what they were like banks. They were lending banks, but they were very good at assessing risk, putting the right operators in. So it's really, absolutely, I think lending balance sheets is critical to the growth in the space. And then it's about structuring it properly to make sure you are taking the right risks and allocating away the risks that you don't want to be taking. If you are one of these majors and you know how to, cover off the geology risks, then great. The construction risk, is that really something you want to be taking on? Or are you going to blow through costs? Are you going to go blow through time? What are these different risks? Can you allocate them away to the people who want to be taking on their risks? And ensuring that you don't have the majors taking on every single risk there because they say, hey, look, I've got the balance sheets, I can do that. And I think historically, kind of over the last 10 years, what we've seen is them doing exactly that. They took on all these risks and you had these monster impairments. And then investors would say, we don't trust you anymore at all. Don't take any risk at all. Hand us back the cash, do buybacks, whatever. Very strong capital discipline. Capital discipline is we just don't trust you. And there's been a very great lack of trust in the major mining houses. I think
not back yet. So is it not coming back yet with the metals prices, the dividends?
Well, these are the things outside their control. The metals prices outside their control. So it's like, what have they actually delivered that's been inside their control? These returns being because of them on a stock specific basis, them actually creating value, or has it been the commodity price has gone up and therefore they all look, like heroes? I think large part has been the latter, and so people are kind of taking baby steps towards these smaller projects. You saw. Rio, for example, saying that we want to be doing this small startup mine sites because they just don't, there's the lack of faith internally in it. We need to justify, prove it to external parties, and all the different stakeholders that we can do it on a small scale and go back to the mega projects. But I think very difficult to take on these mega projects. I mean, we'll see with Anglo with their project, the potash project in Woodsmith in Yorkshire, how that goes. But that's one that's clearly everyone's looking at here in particular to see what happens.
So is this the beginning of a sort of portfolio diversification or repositioning amongst the majors that we're starting to see?
Yeah. So I do think this is really interesting because there's a great paradox that kind of exists in the commodity space where the worst commodities end up being, well, I believe at least, the best commodities, and the best commodities being the worst commodities. I mean, what you have in copper is everyone loves copper. We all know the super cycle story. It's energy transition on the demand side. We've got lowering grades. We've got difficult jurisdictions. We've got cost blowouts. We've got everything you want. So consensus pricing going out is in massive contango. Price is going to be higher, go on forever. So everyone's recycling their capital from these very bad commodities, coal and iron ore, where the supply side discipline is very poor. It's ubiquitous products. It's very easy to get out. You just put more trucks in the ground, and there's lots of real option value in the asset. So you say, look, I don't want to invest in that. Group strategies generally, BHP, Rio, Anglo, group strategies are that we don't want to be investing in those cash flows. Look at the forward price, some massive backwardation. It's about to fall off a cliff. We have no confidence in it. Take all those cash flows and invest in growth in the energy transition metals. And therefore, the irony ends up being, or the paradox ends up being, that you never get the high commodity prices in the exciting stuff because you're pouring so much capital into this classic capital cycle, whereas you're starving the assets over here of capital. So they're the ones that are actually very exciting. You're kind of seeing that, coal is the great coal versus copper. What we've seen in the last 18 months. These obviously take a long time to play out, but for us that is kind of a quite exciting theme that you will probably see, going into the next kind of 10 years, really.
Yep, excellent. Coille, what's your view on the sort of gold copper side for the majors? Are you expecting more M&A coming to prove more relevance to their share price, or how do you see that?
Yeah, I think in the gold space, most of the seniors, if not all of them, are in a net cash position, so their balance sheets are very, very strong. They, on average, have a 2% div yield and high single, double-digit free cash flow yields. And in the last cycle, you saw them immediately cut exploration. That was the easiest thing to cut. And recently they've been reinvesting in exploration, but brownfield exploration, that only goes on for so long. And then as they're we may not like $1,800 gold when we were at 2000, but their margins are very robust and they just continue to add cash to the balance sheets. And, their average, reserve life is about 10 years right now. The grade's much lower. We all know these stories. It's not like, the quality of their asset base they're all getting long in the tooth. So I think as as they start to look around and, it takes 10 to 15, 20 years to bring on a real project. So you need to start going down. And to me, this is the beginning of a good M&A cycle for juniors because, if they haven't been bringing them along internally, they're going to have to look externally, and they finally have a balance sheet where they're able to go buy these things. And I think there's probably a bit of finally just some overlap in terms of juniors wanting to sell. Historically, that's been a big problem, juniors not wanting to sell their projects, but we're getting better valuations. And I think finally there's going to be some overlap to get some actual deals done.
Excellent. Cailey, what's your take on the majors? Do you think they need to play more into and have a better dialogue or JVs or M&A even with the junior tier to help bring this supply online?
Probably yes is the short answer. It's just they're in a sort of tricky situation. They're absolutely right. They're in a fantastic shape. We're not going through the 2008 crisis of having dodgy balance sheets. They're in very good shape. But what are they looking for? They're looking for projects that can make a difference to their company. So they need world-class size projects. Sounds a bit like Blackrock. So for them to invest in those kind of things, the opportunity, we can't get around the fact the opportunities for world-class projects are getting rarer and rarer by the day. So it's a tough environment for them. I think it's not down so much to a lack of willingness on their part. They want to do more, and they do it on some of the earliest. I would probably like to see them do it more on the earlier stage stuff and invest on much earlier stage projects. They do a bit of that, but it's kind of tough. And don't forget, they've been beaten up for the past decade about destroying shareholder value, capital allocation, where's the dividends, guys, et cetera, so they've got to balance the needs of the shareholders against the sort of needs of the industry, if you like. So yes, there's probably capacity for them to do more. Will they do more? I'm slightly more skeptical about that. I think that it's going to be tough. We'll probably just see pretty much more of the same in my view.
Do you think there's like sort of a Rio moving into lithium or something? It's not the skill set that they're used to, and that's a major inhibitor for majors to sort of diversify in that respect.
It's a bit like the Japanese too. It's as much as the skill set as the technology piece. So what we've gone through is technology discovery in EV batteries, for example. How important is lithium to that? Well, we're sort of coming to the conclusion that it's pretty bloody important, but that's what's held them back for a lot of that investments over the last few years, and now they're sort of coming to it late and coming to it with more blinkered eyes. So, like to James and Phil's earlier point about, you know, the supply issues, it's hard to. It's not just the product, it's just getting these mines online, commissioning them on time. It's a lot harder, and that is adding to the supply issues. So I think they do want to do more. It's just finding the right projects that are available to them, and they have to take chances on certain things, as Henry said, like on Woodsmith. You know,
just on that point, the majors, there's an interesting dynamic as it pertains to, you know, all the commodities that we need for decarbonisation, and that they're really just focused on copper and nickel, and that's basically it, because the rest of the stuff doesn't really flick the needle for them, and that's a big problem for the industry as a whole. But it's also a really interesting opportunity for the juniors and for investors like ourselves to find a way in to play that space. And so that's what we're focused on.
James, do you have any thoughts on that?
I mean, the majors have done a great job in the last 10 years in repairing those balance sheets and starting to earn back investors' trust. Now, we can debate how much was down to them and how much down to the commodity price, but they certainly haven't gone and squandered that capital, and they have repaired their balance sheets and sort of moved towards certainly in all cases a sustainable debt position, and in many cases a net cash position. In an inflationary environment, I would pose the question, does that start to shift, and that cash on the balance sheet starts depreciating by 10% a year, and you've got a commodities where, okay, we might see some definitely short-term support, but if you're an investor looking 20, 30 years out, you know, what does the coal market look like in 20 or 30 years? It looks a lot smaller. Maybe it has higher prices still because you don't make investments, but it's certainly a smaller market. So I think the majors are in a position whereby, yes, they have to make that transition. Really, the re-rating opportunity for them is, do they buy the right projects? For one, are they in the right commodities? And can they build these mega projects successfully? Because as Henry rightly pointed out, that used to be where they added value. And if they, I would again pose a question, if they really want to start adding value again, that's a skill set that they either have to showcase or in some cases develop and start building out these mega projects, because their cost of capital is so much lower. They're the only guys that can do this effectively. So they have to invest in these growth areas, invest in these mega projects which we're going to need in these growth commodities, and do so efficiently and effectively and bring them on. And that's going to be the re-rating opportunity for the majors, in my view.
Excellent. A few of you touched on the inflationary issue. Thinking about it in terms of cost inflation, how impactful is that at the moment? How risky is that for the companies at the moment?
So yeah, for us, just if I chime in there, the real bread and butter of what Orion is a long-term patient form of capital. But really, 2/3 of what we do is project finance, right? It's construction capital across the capital structure, and so there's probably about a dozen projects in our portfolio right now, and as you might imagine, that's a bit of a problem, right? Inflation is ripping through the portfolio right now. And so it's something that we've really had to think carefully about. How do we manage that risk, together with our portfolio companies? Unfortunately, we did forecast that this might take place a few years ago. And so as we go through our due diligence processes, we ensured that there was enough in the kitty for most of these projects to see it through. Now, it has been exacerbated by the war in Ukraine significantly. And so the problem itself has got more severe. But it looks as though we're in the fortunate position where most of the projects that are suffering from this got decent management teams and can manage it. They're low cost, high quality projects, and so can raise additional capital if they need to, and in the right commodities, the exciting commodities of this thematic of a generation, decarbonisation.
Well, I would just make the comment that a lot of the guidance that companies are giving on costs are probably out of whack, to put it bluntly. We are in a horribly inflationary environment, and the last thing, we're in a sector that is striving for confidence from generalists, And the last thing they need is to know that companies are missing on their results because they're not meeting the cost guidance that they've put out. So I think we just need to be realistic. It's going to be very tough on project builds, which exacerbates the whole commodity cycle we've talked about. But I think we just you probably need to put a lot more fat into numbers and put some realistic estimates about how bad the environment is at the moment.
As an active manager, it's a huge opportunity to add value, especially if you're a long-only manager like ourselves, purely in equity. I mean, being able to identify those companies whereby they do have that backward integration and can control their costs better on the operating side, and they're going to see their margins explode. That's a huge opportunity for us to add value, and that's what we spend a great deal of our time doing. So, yeah, this environment is inflationary. It is very difficult. Greenfield projects are exceptionally difficult for us to value right now. Very, very, very hard. We focus on those cash flowing. On those cash flowing companies, and we're spending a great deal of time looking for companies that can control their costs better, because those are the ones that are going to see margin expansion, not erosion.
Coille, you looked like you wanted to comment on
I was just going to comment. I think it also depends on where the asset or where the company is located. I mean, we often forget about foreign currencies, and as there's inflation, those home currencies are going down, and 40% of your costs are labor, then you have a natural offset. And so sort of paying attention to what things are being pressured and what's going to have the biggest impact is important as well. It's not just USD inflation. It's not going to impact all companies the same.
Okay, let's quickly talk about investing now at this point in the market. Is it a pause from you guys up here based on lack of world-class assets coming online, some of the inflationary pressures that we've said, the volatility in the metals prices, or is now quite opportune?
Look, I think we see a lot of opportunity. I think everyone's the volatility is effectively causing a higher cost of capital, which is feeding through in more attractive valuations. So within the market, there are a lot of very attractive valuations, and I guess the question is, do we see in some commodities the temporary issues resolving pretty quickly, or in other commodities, the temporary issues not resolving, i.e. the things that are causing prices to rise today, how long will they take to unwind, and what's the market pricing? And on the other side of what I meant from the first bit was, if there's been a temporary, we talked about iron ore earlier, how do we kind of believe that's going to normalize? How quickly will that normalize? So within the equity space, valuations are highly differentiated at the moment. Different equities within different commodities. So it's kind of rich pickings for the active fund managers at the moment.
Anyone else want to comment on that?
I think that the most interesting space at the moment is the streaming space. Particularly if you can get production, because you're inflation protected. You can get some fantastic valuations. As we all know, the publicly listed streaming companies do trade at fantastic valuations. And so that's been a cornerstone of what we've done. It's probably about a third of the portfolios in streaming. And so if you can connect that with, the energy transition commodities, which I keep saying is the thematic that we're focused on, then it's a really, really interesting combination.
Anyone else on capital allocation now?
Well, I mean, I think I touched on it before in terms of this is a great time to be an active manager in terms of the cost differentiation we've seen. I mean, I can't remember an earnings season quite as volatile as this one, with such dispersion around where consensus was and how companies have performed, but both for good and for bad. So that's the opportunity for us, and just focused on those companies whereby they are able to control those costs in those commodities which do have an attractive growth profile. But this is going to be volatile, and I think it's going to continue for a while.
Yep. Anyone with any questions? We've got 10 minutes left. Anyone put a hand up? Question for our panel on anything? Commodity picks or anything else? No. Yep. Gentleman at the back here. I'll bring a mic down to you.
One, two, testing. Right. Can you hear me? Yep. Keith Rowe Wilson from Gerald Group. you've obviously all been talking to the supply side, inflationary pressures, cost pressures in mining and getting projects up and running to supply the demand side. What about the demand side? What about building plants, building processing plants to actually take on the raw materials to produce the products that are required for the energy transition? And how are the decisions taken by the demand side to actually build those processing plants?
Yeah, it's a very good question in terms of, particularly around those more specialist commodities in terms of, okay, we're getting to a certain grade of lithium, for example, or nickel, for example, or rare earths, but we need to take that on to the next level to make that a usable product. So I spent last week visiting a rare earths factory in Estonia, asking that exact question. It's like, well, you guys see the growth trajectory just as we do. How are you going to expand? And importantly, at what capex intensity can you expand, and how are you going upstream and securing that supply? So that's a huge piece of the puzzle, particularly around, mainly around this energy transition metals, and that intermediate step between, okay, we're producing a product from the mine gate, but often that needs to be further refined and processed before it goes in to the end user. And that midsection is increasingly becoming commoditized. So we've seen that particularly around the cathode powders and the margin pressure which those guys are under, and it's been well publicized with JMAT earlier on in the year, and Umicore having some cost pressures, but now being able to mitigate those somewhat. So that's a huge part of the puzzle, and it's certainly an area we spend a great deal of time in, because we also invest in that sector of the market as well. And traditionally around rare earths, that's where the money's been made. It hasn't been made at the mine gate because of the particular supply dynamics of that commodity. It's been made at that intermediate processing part, where can the processes take the entire suite of metals and effectively market them, and that's the tough bit for that commodity as well, not just the processing to spec. So it's a good question. It's something that you have to judge on an individual commodity by commodity basis, and increasingly on a regional basis as well, as we sort of move to onshore supply chains. Again, that's a crucial part of it throughout that supply chain.
Yeah, I mean, I forget the numbers now, but a standard turbine versus the amount of wind turbines you need, about 30 wind turbines to produce the same power output as a normal turbine, and then you're sort of 100 times the amount of copper, cement, etc., required. So you're absolutely right, but I think it just depends on the speed of the technology adoption curve. If you look at mobile phones and so forth, it's exponential, and how quick we're hopeful that EVs would probably be the same as well. At the moment, that sort of has been delayed, but I think it will happen. I think you're absolutely right.
Okay, anyone else with a question for the panel? No? All right, but if anyone wants to put a hand up, we've got a few minutes left. I want to talk about, we talked about the majors, talk generally about sort of how you're looking at juniors at the moment, but do you have any messages for the junior miners at the moment? What do you want to see from companies in your portfolio? I guess it's all case by case, project by project, but is there a message for the juniors at this point in the market?
Yeah, I would say from our perspective, it's very interesting to kind of, the junior kind of presentations and the technical reports, etc. They will be talking kind of about the financial returns only. I think as a group, the majors have kind of been pushed very hard into talking kind of stakeholder returns. From the juniors in particular, where you're going into a new, it's often a jurisdiction that's a difficult jurisdiction. It's one with low unemployment. With high unemployment and with low skills, and they'll be bringing a lot of these different things to that area. I think it's very important when you are engaging with potential shareholders, when you're doing capital raises, to talk about those aspects as well and to think about them. What are you really bringing to that host government, that community, all the different stakeholders, and critically, are those stakeholders aligned with your project? Because that's where so many these things go wrong, in particular when you kind of move from construction to production. Suddenly everyone says, now's my time to have a piece of the pie because you've sunk all the capital into it. So just to ensure that all the different stakeholders are aligned and kind of what type of value, what kind of value, to some level it is quite qualitative, but to have that kind of discussion, to bring that discussion into your kind of presentations and discussions with capital providers, whether whoever they are.
Yeah, just to answer that point on ESG, I think it's important to recognise that international providers of capital now look at ESG pretty much number one of the list. And so, for us as an organisation, we will not invest in a company unless it aspires to best practices. So we're talking here about where relevant IFC performance standards, the Equator principles, the global industry standard on tailings management, all these international best practices is a kind of a yes or no. And it's very, very hard to see when you look at the junior mining space, which of the companies want to do this and which of the companies do not want to do this. And on top of that, I'd also say that we need to sort of change the focus away from have you got your permits in to do you have the social license to operate? Because as we've seen time and time again recently, it doesn't actually matter if you've got the permits in. You have to have the social license to operate, because if you don't have that, you will not operate.
Is that becoming one of the biggest risks to the sector at the moment, with the sort of what we're seeing, globally, social license?
There's certainly an impact in terms of the provision of capital. I'd say that it's almost like a working capital problem in the sense that it takes longer for CPs to be met, the conditions precedent to investment, before the capital can be released in order for these assets to be built. That is true, because it does take time to prepare to adhere to these standards. A significant amount of time. I mean, you're talking here about like many years. So I think that it's important to the junior mining space that preparation begins, like kind of at the pre-fee stage, maybe even earlier, to ensure that the moment you're ready to build, that you are genuinely ready to build.
Was there a question at the back? Yes, gentleman there. Do you want to?
One of the comments that was brought up is about the cash positions that are being built by some of the major diversified miners. And you also referenced the concerns and potential for M&A activity. But I suspect that investment banks will probably drive that outcome, and the first M&A transaction that occurs will then drive a cascade of other transactions. We saw that 10, 12 years ago, and the industry is very good at repeating its own sins. Do you think, A, that's probably going to occur possibly later this year, and B, that ESG would actually be a filter for some of those diversified miners when they're looking at these projects?
Yeah, it was my comment about the building up of the cash positions and inflationary pressures depreciating the value of that cash. Yeah, I think you'd be very naive to think we aren't going to repeat the same mistakes that we've always repeated in this industry. It's incredibly cyclical, so we'll get high prices. Capital will start to flow into the sector. We'll all get overexcited, and we'll start to spend money on stuff we shouldn't spend money on. I mean, we all hope it doesn't happen and we learn our lessons, but we've done it every single time we've had a cycle, and we'll probably do it again. ESG is going to be a filter, certainly, but I think we're all agreed with that, and the paradigm has changed there. But my point was really about where the majors are going to add value is how well they select those projects, because they are going to have to select new projects to build, and they're going to have to build them successfully, and that's going to be the opportunity for the re-rate there. Some will do it really successfully, and they'll be the companies that go on and do really well for their shareholders, and some won't, and they'll be the companies which we're talking about in 10 years' time, destroyed value and have big write-downs, and have spent the last decade repairing their balance sheets again. That's my view.
Yeah, we've got a minute left. Go on. Yeah.
It's just because in the gold space, in the last cycle, deals that had no premiums, those shares outperformed the index, and then guys that came out and paid 20-30% premiums, those shares underperformed. So I think that it's going to depend on the deal structure and how it's done. And I think there's going to be much more focus on actual synergies and why it makes sense to do this, as opposed to just growing for the sake of scale. I don't think anyone wants to see that anymore. If you're actually doing a deal that is going to increase your margins on a per share basis, or your cash flow, or your reserves, I think the market's going to be fine with that.
Yeah, we've also had we get a lot of questions about, is bigger better? Because of course it's never been, has it? But in fact these days it is, sadly, because of liquidity. There's less liquidity in the markets than there ever has been, and we struggle to buy your shares. Simple as that. All of us do. So, well, exception Phil. But So that's sadly bigger has become better, and I think we will see that's going to drive a lot of M&A. And it doesn't necessarily mean it's going to make a better company, but it might mean you get a better audience, for better or worse.
Okay. We're pretty much out of time, so unless anyone's got anything pressing, I think that's it. Can we have a round of applause for our panel?